Hello, everybody. This is Sunko, the Korean bro. Today is 2023, June 26th. Let's see, okay? Hmm. So, what articles do we have tonight? Let's see. Hmm. First, let's see. Hmm. Why the Fed's upcoming stress test results could be a catalyst for Citigroup. Um, Too low price stash that could make you richer. The AI stat jumped 163% this year, and Wall Street thinking it rise another 50%. Is that realistic? Is GSK a strong buy right now? Three ways to grow $100,000 into $1 million for retirement savings. Okay. First, what I'm going to read is too low price stock that could make you richer. Janus a waiting game. Therapeutics. And we have this AI stats on 163%. That's not expensive. The company can meet the CEO's projections, and Wall Street is coming around to agree. Super microcomputer. Okay. This hardware stock may seem overextended, but there's a very plausible path higher. Investing in leading cloud and semiconductor stocks have probably seen big gains this year, as the artificial intelligence revolution sparked by the introduction of ChatGPT last November began translating into blockbuster revenue and profit gains for well-positioned companies this spring. The stock has climbed 163% in 2023, but what's even more impressive is that unlike some other tech stocks that were down in 2022, Supermicro is achieving these gains after rising nearly 87% last year. Remember, that was in a year in which the Nasdaq Composite fell more than 30%. Although the stock has nearly quintupled in a mere 18 months, one Wall Street analyst recently upgraded Supermicro while raising her price target to $325. 3 ways to grow $100,000 into $1 million for retirement savings. Make sure your portfolio is diversified. take advantage of dividend payments, long investment window. Some people don't begin to focus on retirement savings until they're in their 40s or beyond. But if you want to 10 times your savings, you may need to start building a nest egg a lot earlier than that. Branch out in your portfolio, put your dividend to work. Paramount Global. Book. Okay. Hmm. Mm, okay. Second, scorching hot summer buy that's fully capable of tripling your money if you allow the investment thesis to play out is dog-focused products and services company Bark. The stock chart shows that Bart is one of many special purpose acquisition companies that got ahead of itself in the valuation department. Co-founder and CEO Matt Maker now has his company on the right track. Before diving into company specifics, it's worth pointing out just how resilient the pet industry has been throughout the years. Data from Data from American Pet Products Association shows that 66% of all households own a pet. 66% of all households own a pet. And more importantly, a year over year, US pet expenditures haven't declined in more than a quarter of a century. Pet owners freely open their wallets in any economic environment to ensure the health and happiness of their companion. One of the factors that makes Bark so intriguing is its operating structure. Anywhere from 10% to 15% of its revenue derives from products sold in Bark and Motor stores. Meeker and his team are continuing to build on Bark's relationship with brand name retailers and should be able to get its products in more doors over time. However, the bulk of box sales come from monthly subscriptions. Although many of these subs are for the company's core toy and treat subscription service, Bark is making headway with a number of high margin add on opportunities. In particular, the company's Bark Food segment, which delivers breed specific dry food to owners' homes and Bark Bright dental support products, offer rapid growth potential. Add-on sales are Bart's ticket to juicy gross margins and subscription retention. Lastly, management has been trimming the fat as needed to move back to operating sustainability. The fiscal fourth quarter saw the company generate $19.1 million in net cash from operating activities and $16.7 million in free cash flow. That's a big step toward recurring profitability and self-reliance. So 66% of all households own a pet. Pet owners freely open their wallets in any economic environment to ensure the health and happiness of their companion. The company's Bark Food Salmon, which delivers breed-specific dry food to owners' homes, and Bark Bright dental support products, offer a rapid growth potential. PayPal Holdings. Okay. The third scorching hot summer buy that can triple your money if you're a long-term investor is leading fintech company PayPal Holdings. Despite fears of a US recession, historically high inflation rates weighing on PayPal stock over the past couple of quarters, all of the company's key performance indicators are headed in the right direction. For starters, the global opportunity for financial technology solution is seizable. According to an estimate from Boston Consulting Group, fintech revenue is expected to grow sixfold. from $245 billion to $1.5 trillion by 2030. PayPal finds itself on the cutting edge of a game-changing shift in how payments are completed. The total payment volume traversing PayPal's digital networks, which includes Venmo, supports the idea that fintech adoption is rapidly growing and still in its early innings. The company sustained a double-digit currency neutral TPV growth last year, despite the fact that the U.S. gross domestic product declined in the first 6 months of 2022. TPV growth has remained in the double digits, excluding currency movements, through the first 3 months of 2023. During periods of strong economic growth, 20% or greater TPV growth has been common for PayPal. Investors should also be thrilled with PayPal's strategy improving user engagement. As I recently pointed out, PayPal closed out the first year of the pandemic with active accounts completing an average of 40.9 transactions over the trailing 12 months. As of the end of March 2023, active accounts completed an average of 53.1 transactions over the TTM. Since the majority of PayPal's gross profit derives from fees, a more active user base translates into higher profitability and operating cash flow. Lastly, management is making moves to put shareholders first. Uh, Amid a temporary slowdown in growth, the company aims to cut operating expenses by at least $1.3 billion this year. Meanwhile, PayPal is diverting roughly 75% of its free cash flow toward buybacks, which can increase earnings per share for companies with steady or growing net income. Fintech revenue is expected to grow sixfold by 2030. The total payment volume traversing PayPal's digital networks, which include Venmo, supports the idea that fintech adoption is rapidly growing and still in its early innings. Companies sustained double-digit, currency-neutral TPV growth last year, despite the fact that the U.S. gross domestic product declined the first 6 months of 2022. Lastly, management is making moves to push shareholders first. Amid the temporary slowdown in growth, the company aims to cut operating expenses by at least $1.3 billion this year. Apple, of Buffett's eyes, Nvidia, and Toast. Okay, today what I'm going to look at is Wix.com. Let's see how Wix.com is positioning itself for success. Wix is actively incorporating AI into its products. AI can help the company operate faster and smarter. Wix could emerge as a winner in the AI race. In the rapidly evolving landscape of artificial intelligence, businesses are witnessing both transformative opportunities and unprecedented challenges. Amid this revolution, Wix.com is positioning itself to thrive over the long term. Here's how Wix.com is leveraging artificial intelligence to its advantage and reshaping itself in an AI driven world, using AI to deliver a better user experience. In the early days of the internet, it was tough for entrepreneurs to launch business thanks to the complexity of building websites. Wix entered the scene in 2006 to help anyone build a website with little to no coding or design skills needed. Over time, the company evolved and added new tools, including e commerce solutions, payments, logo designs, and more, to help businesses succeed online. The rise of AI technologies has given Wix another opportunity to deepen its relationship with customers. As a start, Wix plans to incorporate AI, proprietary, and action into its product to reduce friction for customers to launch and scale online businesses. With the help of AI, customers can build and customize websites faster, improve search engine optimization. With the help of AI, customers can build and customize websites faster, improve search engine optimization, speed up workflows, and more. For example, Wix has been providing an AI-enabled website creation platform, Wix ADI, since 2016. What Wix ADI users can give a series of prompts, and the AI will recommend pages, images, and text for the project. Another example is Wix's recent introduction of Wix AI Text Creator, which leverages OpenAI's GPT-3 to help businesses create content. The idea here is simple: incorporating AI into its products can help users achieve their goals more effectively. Consequently, user satisfaction will improve, leading to higher conversion and retention. Ultimately, AI can help Wix grow its businesses in the long run. Using AI to improve operational efficiency. There is enormous complexity in running software company like Wish. It not only has to move fast, launch innovative tools to serve customers, but it also has to deal with increasingly complex internal workflows and processes. Fortunately, AI can help here too. For example, with the help of generative AI like ChatGPT, Wish can deliver software updates faster and cheaper. Also, with AI automation, the tech company can streamline its business processes, cutting out repetitive tasks and their associated costs. In short, AI should help Wix do more with less, which is vital as it strives to improve its code structure and grows its free cash flow. To this end, Wix is committed to achieving the Rule of 40 by 2025. This rule suggests that a healthy software company should have a combined percentage of revenue growth and profitability margin of at least 40%. In the first quarter of 2023, Wix reduced its headcount by 18% year over year while growing its top line by 10%. Its adjusted free cash flow margin also improved to 12%. So, given more management's rule of 40 aspirations, the tech company has improved its combined revenue growth and FCF margin from 9% and 21% in the third and fourth quarters of 2022, respectively, to 22% last quarter, a clear upward trajectory. While we cannot pinpoint the impact of AI on these improvements precisely, I bet it's playing a growing role in helping the company deliver these results. Wix is positioning itself to win in an AI driven world. AI is shaping up to be one of the most disruptive forces in our time. As the AI revolution reshapes industries, Wix.com is strategically positioning itself to benefit from this trend. By incorporating AI into its products, such as the AI enabled website creation platform and AI text creator, Wix enhances user experience, helping them achieve more with less. Besides, with AI automation and pursuing the Rule of 40, Wix may be able to streamline its internal operations to achieve sustainable, profitable growth. Let's go see Block. Block. The best stock should invest $1,000 right now. But let's see. Both of Block segments are posting incredible growth, and the business is on the verge of positive net income. Netflix's new ad-supported tier should only improve its financial situation, which is already strong. Okay, first, through its Square segment, Block offers merchants mission-critical services such as payroll, invoices, card acceptance, and working capital, tools that make running day-to-day operations easier. And through its popular Cash App service, Block it lets customers seamlessly send money to friends, set up direct deposits, or buy stocks in Bitcoin. Both segments' gross profits rose by double-digit percentage year over year, which I view as extremely impressive growth given the uncertain macroeconomic environment. On the bottom line, Block's net loss of $70 million in the first quarter was much better than its $204 million losses in the year ago. Uh, by cutting its sales, marketing, general, and administrative spending, the business is optimizing its costs. And consensus estimate actually called for a diluted earnings per share of $1.72 in 2023 and $2.40 in 2024, a welcome outlook after its big loss in 2022. According to the company's most recent letter to shareholders, Square processed $46 billion in gross payment volume last quarter, and Cash App now has 53 million active users. Despite what are obviously two sizable segments ready, management believes that Block's prospects are incredibly strong. They view the total addressable gross profit opportunity for the overall business at $120 billion. To capture more gains, Block will stick to its proven playbook of launching new products and services and entering new markets. As of this writing, Block's stock is down by about 77% from its peak price. A multitude of factors such as high interest rates, slower economic growth, and a bearish research report have pressured shares. But I think the long-term outlook remains robust for its this business, and its current price sales multiple of 2.1 offers an attractive entry point for investors. It's hard to find a more impressive fintech stock than Block right now. One soaring growth uh, stock that's still an unbeatable bargain. Emoji is a medical device maker gaining a share of the rapidly growing market for minimally invasive cosmetic procedures. Despite a tough period for making comparisons, Emoji reported first quarter sales that rose 23.5% year over year. Looks like permanent procedures performed with emotes minimally invasive devices are pulling market share away from temporary injectables such as Botox. This company's minimally invasive alternative to liposuction surgery isn't getting the attention it deserves. Are you looking for an underappreciated growth stash that can deliver big gains? Try starting your search in the rapidly growing industry for minimally invasive cosmetic procedures. The global the global market for non-invasive aesthetic treatments reached $61.2 billion in 2022 and is expected to grow uh, by 15.4% annually through 2030, when minimally invasive skin sculpting tools that produce results similar to liposuction. Emode is well positioned to ride this trend. This medical device maker keeps reporting impressive growth on both its top and bottom line, but the stock market hasn't seemed to notice. Right now, you can buy it at prices that look like an unbeatable bargain. Another outstanding performance. Full blown cosmetic surgery requires in person meetings with doctors and surgeons, which just weren't possible during the COVID-19 related lockdowns. The pandemic pushed a lot of folks who would have opted for traditional liposuction toward practitioners with minimally invasive devices from InMode. For example, InMode's device inserts a narrow probe under skin using proprietary radiofrequency technology to liquefy fat cells. The pandemic driven push toward less complicated procedures has ended, but sales growth for Emode is still strong. The company reported first quarter revenue that rose 23.5% year over year. Providing cosmetic surgeons with new equipment is only part of Emode's business. Down the road, Emo will likely earn more by sadly selling consumer accessories that must be replaced between procedures. First quarter sales of consumables and services shot up 43% year over year. This suggests patients receiving treatment with one of Emo's devices are returning for more and telling their friends. In addition to its minimally invasive body tight device, Emo's market entirely non-invasive device that smooth wrinkles. In this respect, Emoji compete against injectables such as Botox from AbbVie, and it appears to be winning. In the first quarter, worldwide sales of Botox for cosmetic procedures rose just 2.9% year over year. Emo's total sales expectation for 2023 is a significantly smaller sum than the revenue cosmetic Botox generates for AbbVie in a single quarter. In other words, there's plenty of room for Emo to grow. It's easy to understand why people gravitate toward procedures and perform with Emo's devices. The effects are more or less permanent, while Botox is famously temporary. At the moment, Emote is mostly focused on cosmetic procedures, but it's expanding into health and wellness. For example, it recently launched an ophthalmology platform called Inizuni in Canada, and the company expects to launch this new platform in the US this year. This has led to some terrific growth numbers for the business. This year, the company projects that its top line may rise by at least 16%. There are no shortage of reasons to be bullish about Emode. Are you looking for a stock to buy that's generating strong growth and trading at a low valuation? It's not easy to find a combination given the current economic conditions, but that one that could fit the bill is Emode. The business has been performing exceptionally well, but shares are still undervalued. It may even be the best healthcare stock to buy now, and here's why. With US economic growth slowing, many fast growing businesses have been laying off staff to cut costs after previously overestimating their growth opportunities. Emode, however, is still firing on all cylinders. A company known for machines that perform minimally invasive cosmetic procedures and body treatments posted impressive first quarter results this month. Sales were up 23.5% year over year to 106 million, and for 2023, management projects revenue of between 5 million and 530 million, up at least 16% from 454 million reported last year. But while the growth rate looks strong, it has been slowing down, at least compared with where it was during the early stages of the pandemic when consumer spending was so strong. As the business's growth rate has slowed down, the stock has also fallen in value as well. But the growth rate was unsustainable to begin with at those elevated levels in 2021. Now it's tracking at a more reasonable price. Okay, E mode. EPAM systems. Having to pivot its operations significantly due to the war in Ukraine, profits are taking a hit, but the company is still growing revenue. EPAM's long-term advantages are intact and bode well for its future success. EPAM is proving the durability of its competitive advantages and the resilience of its business. Shares of EPAM, a leading IT consulting company, plummeted over 50% in a matter of 2 weeks after the beginning of Russia's conflict with Ukraine in February. Ukraine, Belarus, and Russia collectively were home to about 60% of EPAM software designers and engineers, and with the war, EPAM's business was facing a serious threat. But as they say, adversity reveals true character. It's true for people and true for businesses. EPAM's second quarter 2022 results, announced a couple of weeks ago, show that the company has navigated this highly complex situation brilliantly. Investors want to trust business that can stand the test of time, and EPAM has reinforced why it deserves their confidence. EPAM reacted quickly with focused employees and customers. EPAM provides IT consulting software engineering services across the world. Its global workforce, operating from about 50 different countries, powers its wide ranging services from strategy to development to operations for clients in a variety of different industries. As the war broke out, EPAM's first priority was ensuring the safety of its people in the region, and the company took immediate steps to move its Ukrainian employees to safer locations within the country or nearby countries. Many of its employees in Russia are also moved. To ensure continuity for its clients, EPAM relocated a lot of work delivered by employees in the region to other parts of the world. The company also accelerated hiring in those regions to make up for lost productivity. Of course, EPAM had to make substantial financial investment to execute all these actions. But I'm impressed shifting large and complex IT projects and realigning teams across the globe without causing massive disruption is really hard. EPAM did that literally over a period of weeks. This shows the high caliber of talent at EPM, the structure and processes the company has proactively put in place, and the ability to operate under intense pressure. Okay, anyway, this is it. I've read too much today. I read articles about EPAM systems, and what else did I read? Uh, PayPal Holdings, Wix.com, eMode, blog. So, anyway, I'll see you guys tomorrow. Bye bye.